Hi there, and welcome back to the DGI Crab. Today, I want to talk about why dividend growth investing is my preferred method of investing. Got four reasons here for you today. You might have a few more that you can think of as well. Feel free to leave those in the comments below. But I want to go over this because dividend growth investing is just such a powerful way to consistently and passively build your wealth. And hopefully, after we go over these reasons, you will agree with a lot of what I have to say here. Before we get started, I do just want to say I'm not a licensed professional investment advisor. So, whenever you are investing into the stock market, definitely do your own due diligence. But with that, let's go ahead and get started. So, the first reason is there is a low barrier to entry. So, what that means is you only need a very small amount of money to get started as a dividend growth investor. And in today's world, thanks to platforms like Robinhood, which really sort of blew the doors open when it comes to this, and SoFi, they have no trading fees and you can get started investing for as little as $5. You don't have to buy a full share of an individual stock or an ETF. You can get in for as little as $5, buy fractional shares, and automatically have any dividends that you receive from that investment get automatically deposited into your account as cash. Or what I like to do is have the dividend reinvestment just automatically turned on. So even if I'm just getting a small payment of less than $1 in dividends, just having that passively reinvest back into the underlying investment to continue to add shares and increase the payment of dividends that I'll get on the next time around as well. Second reason is you have so many options as a dividend growth investor in the stock market. So you can invest in single stocks, you can invest in ETFs, exchange traded funds, or both. And ideally, you would do both. Now, I personally think that you should have about 50% of your portfolio, if not a little bit more, dedicated to ETFs, because that way you'll always have a good solid amount of diversification in your portfolio, and your portfolio won't take massive hits or drops in value. If because like if you have a single stock and for whatever reason they decide to cut their dividend or their share price just craters for a long period of time, that can be really scary and and cause a lot of people to panic. So if you have a fair amount of ETFs in your portfolio, you'll know that even if one of your individual single stocks isn't doing particularly well at a given time, your overall portfolio should still be pretty safe. So there's a lot of different sectors, a lot of different companies that you can choose from, and you can bargain shop essentially, which is really fun. Depending on what's going on in the market, sometimes, like as of the time of this recording, like real estate is not doing particularly well in the stock market, but like technology and financial companies are doing pretty well. So this time 6 months from now it might be the other way around and real estate might be booming and tech may be on sale or banks may be on sale or big oil may be on sale. So you could just sort of seasonally bargain shop, which can be a lot of fun. It's fun to go to a store and buy items that for a really good price that are on sale, and you could essentially do the same thing with the stock market. And then you can buy and sell whatever you choose. Your cash is fairly liquid. So if you have to come up with some fast money for some reason, for an emergency or whatever, you may have to wait for a couple of days, but for a sell of a stock to close out and you can officially get access to your money. So it's not quite as liquid as say like a savings account, but if you absolutely needed to access some money quickly and you had a fair amount of different positions, you could just decide which one of those or which couple of those you wanted to part with or reduce down if you needed to get access to some capital quickly, which you can't really do that with some other investment vehicles out there. Reason three, this is truly passive income. So as I said, your dividends, they get automatically paid into your account. You don't have to lift a finger in order to receive those dividends. All you have to do is just hold the stock or the ETF on the ex dividend date, which is just the date that the dividend gets announced. And they'll look at it, they'll figure out how many shares that you own and how much of a payment that you are going to receive. And if you think about the different ways that people try to go about generating money, like rental property, buying rental property is not passive. You have to manage the property, even if you are um, basically pawning off that work on like a property management company, for example. You're still going to have to manage it to a certain extent. You're going to have to look and see, is my property renting? Is it just sitting out there empty for months at a time? Even if you do have a property management company, if the HVAC system or something else goes out in your property, they may be the ones that go in there and actually physically do the repairs and take care of it, but you are still going to have to pay for that and keep track of basically the overall shape of the property and being able to keep up with how good the neighborhood is doing, keeping up with, are there any repairs that are coming up that you're going to have to deal with sooner rather than later. There's a lot of things to think about with rental property, even if you're not physically managing it yourself. Side hustles are not passive. If you have a second or a third job, you're driving Uber, maybe you have an online store that you're selling things on, or you're building websites, or any of the things that people do on the side to try to build passive income. Heck, even having a YouTube channel like this, you've got to put in a fair amount of work in order to get the ball rolling and start receiving the income in the first place. And it absolutely is not passive. It's certainly not just money hitting your account on time every month or every 3 months. And also, when it comes to the stock market, day trading is not passive. Look, I'm a stock market nerd. I like to look at my brokerage and look at my watch list, see how my positions are doing, keep up with individual companies and read about them and how they're doing and keep track of the dividends that they're paying out. A lot of people are not like that. They don't want to have to pay attention to this kind of stuff all the time. And if you're day trading, that means absolutely you are paying very close attention to your account on a day by day basis, if not hour by hour basis, and buying and selling things, um, constantly all the time. And that is a full time job, really, if you ask me, and it's pretty stressful. And then reason number four, and this is the big one for me, the tax advantages. Once you realize just how tax advantageous dividend income is, for me, this was the thing that really sold me at the end of the day. Now, if we look at the 2024 dividend tax rates, you can see here the 2024 qualified dividend tax rate. So these are dividend payments that come from most of the dividend paying companies out there. There are some exceptions to the rule. REITs, which are real estate investment trusts, don't fall under the qualified dividend tax rate. BDCs, business development companies, MLPs, master limited partnerships, don't fall under this. There's a handful of types of stocks that don't fall under this category, but the vast majority of the stocks that I analyze and keep track of on this channel pay qualified dividend income, which means that for single taxpayers, you can receive up to $47,025 in dividends every year and pay zero in taxes. So just imagine if you were at a point in your life where you didn't have any debts, you have your house paid off, and really the only month to month expenses that you have are things like some insurance, your utilities, food, clothing, just the basic things that pretty much everyone has to deal with and pay for, and you're receiving $47,000 in tax-free income. You're pretty well on easy street at that point in most places. You can do whatever you want at that point for work, and you're paying almost nothing in taxes for any income that you're bringing in. And then once you get past that $47,000 threshold, beyond that, you're still just paying 15% for every dollar beyond 47,025, all the way up to just under $519,000. And if you're married and you're filing jointly, you can get $94,050 in dividend income at a tax-free basis. Or if you're the head of the household, 63,000. So again, for a lot of people, this is just going to be a massive amount of money, maybe even enough to just totally live off of and not even have to work anymore. Again, if you have other things taken care of, like a house that's pretty much paid for and no other debts just sitting around. But even if you do still have some debts, this is a great way to have some side money consistently coming in that you're not paying taxes for. And if you've got a second job, you're paying taxes on that. If you have a YouTube channel with revenue coming in, you're paying taxes on that. If you are receiving dividend income from stalwarts like Johnson and Johnson or Procter and Gamble or Coca-Cola or Visa or any of the other excellent companies that this channel focuses in on, then so long as it's less than $47,000 and you're not jumping in and out of positions, selling the stock, cashing out the dividends, etc., at the end of the year, you're not going to pay any taxes on that dividend income. So it's earned passively, tax-free, and with a low barrier of entry, you could start for as little as $5. And it does take time to build up a dividend portfolio that pays you out $47,000 or more in dividends. But if you do it the right way, buy stocks that are on sale, hold for the long term, and that's what this channel's here to help you out with, then you can absolutely reach this point, which is true financial freedom and true passive income that you don't have to lift a finger to receive, and will have little to no stress about whether you'll receive it in the future. So this is Colby, the Dividend Crab. Thank you so much for tuning into the channel. Check out the links below to other helpful videos about dividend investing, and I will catch you on the next one.